Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
The story of YY Group Holding, or YYGH, presents one of the most extreme, frankly baffling divergences we've seen in the small cap space this year. We're looking at a stock that has just completely collapsed. It shed something like 88% of its value over the last year. It's now trading, precariously close to its 52-week low in that critical 20-cent support range. And the velocity of this decline is matched only by its liquidity. I mean, we're seeing daily trading volumes that spike to 50 million shares against a relatively small float, which to me indicates just immense high-frequency trading churn and, I'm going to argue, the systematic absorption of any real price discovery.
That erosion, it is undeniable, but it creates this staggering paradox. Because on one hand, you have this absolutely distressed stock price, and on the other, you have a company that reported, genuinely successful operational growth in the first half of 2025. Specifically, revenue jumped 33.7%, and their gross profit, which was driven by a successful push into their smart cleaning and manpower outsourcing, it surged by a massive 79.5%. It's this almost impossible gulf between the fundamentals and the valuation that we really have to try and reconcile here.
Absolutely. And that gulf is the core of our debate today. The central question for anyone looking at this is really this. Is this divergence primarily driven by, let's call them predatory market microstructure forces, things like dark pools and concentrated shorting, that are actively suppressing the value, or is it fundamentally dictated by the company's own underlying financing and regulatory risks? I'm talking specifically about dilution and the existential threat of NASDAQ compliance. I'm going to take the position that structural forces are what's suppressing a fundamentally growing company.
And I'll be arguing the contrary. I believe that the operational success you're citing is for all intents and purposes neutralized, maybe even rendered irrelevant by a series of really poor, value-destroying financial and regulatory necessities. The stock price collapse, in my view, is a pretty accurate reflection of these critical risks, the massive dilution and the high cost of capital, which just fundamentally overrides any noise from algorithmic churn.
So my thesis is built on this idea that the operational strength of YYGH, their expansion into Malaysia and the UK, and that crucial margin expansion from 12.3% to 16.6% because of their shift to robotics and smart cleaning, is being systematically choked by hidden selling pressure. And the data here it's pretty robust. If you look at the off-exchange short volume ratio, it's consistently sitting between 35 and 42%.
42% is certainly high, but, volume alone isn't necessarily manipulation.
Well, right, but it's not just the volume, it's the routing of that volume. We're talking about upwards of 500,000 shares a day being transacted completely invisibly to the retail market. This high off-exchange flow is, I think, designed to absorb retail buying pressure without letting that buying translate into a higher price on the lit exchanges. It acts as a mechanical suppressor. And what's more, the short interest ratio, the days to cover, is at a very high 6.72 days. This means the shorts are deeply entrenched, and if even a minor positive catalyst comes along, the stock is just primed for a potent dark pool short squeeze because those sellers are going to have a very hard time exiting their positions without driving the price up.
I acknowledge the margin expansion and the operational improvements are there. But I have a serious disagreement with how you're interpreting the financials. You argue the market is misreading the reported $8.2 million net loss from H1 2025 because it was mostly non-cash, share-based compensation, and impairment losses. But the market doesn't trade on intentions. It trades on reported GAAP metrics. And institutional funds and the algorithms that screen for them are highly intolerant of widening GAAP net losses in this kind of high interest rate environment. To them, operational growth is irrelevant if it requires continued value-destroying funding just to stay afloat.
But if the operating cash flow is relatively healthy, which the margin expansion suggests it is, then focusing only on an accounting loss driven by non-cash entries is a clear market failure to price the business correctly.
I would frame that failure as corporate, not market-based, The operational growth, however impressive, is it's essentially been mortgaged. Let's just look at the September 2025 registered direct offering. They sold 6.7 million shares at 60 cents, which is bad enough. But the truly destructive part was the inclusion of unregistered warrants to buy another 10 million shares at a strike price of 80 cents. This is what we call a massive warrant overhang.
And what's the practical impact of that overhang?
It's a structural ceiling. It is a guaranteed supply wall. I mean, why would any long-term institutional investor buy shares above 80 cents, knowing that a major warrant holder can just immediately exercise their options and flood the market with 10 million shares? It guarantees dilution. This financing structure actively caps the stock price near 80 cents, regardless of any good news. The cap is set by corporate action, not market mechanics.
But we're trading at 20 cents right now. We're miles below that 80-cent cap. So the issue isn't the ceiling, it's the floor.
And the floor is dictated by the second and maybe more existential risk: regulatory compliance. YYGH is stuck in a compliance vice. They've gotten deficiency notices from NASDAQ because they failed to maintain the $1 minimum bid price. Given where we are at 20 cents, a reverse stock split, maybe a 1 for 20 to get to a $4 target, is virtually inevitable, probably by early 2026. And historically, a reverse split doesn't solve the underlying financing problems. It often just signals weakness and invites aggressive, targeted short selling. This institutional exodus, driven by that regulatory imperative, is a far greater structural risk than the day-to-day HFT churn.
I do recognize the power of those regulatory concerns, but let's go back to the operational metrics for a second, because I believe they are being just fundamentally obscured. The surge in gross profit, 79.5%, and the margin expansion to 16.6%, that demonstrates legitimate operating leverage. It's validation of their strategy to shift into robotics. This shows the company is successfully moving toward higher-margin, tech-driven services. The market's fixation on an $8.2 million gap loss, which is largely an accounting figure, suggests a profound cognitive disconnect. The business itself, measured by its ability to generate cash from operations, is demonstrably healthier than the stock price would lead you to believe.
I acknowledge the success in margin growth. It is impressive. But we have to deal with the reality of capital allocation rules in 2025. The market simply requires more cash flow certainty. So when institutional screens filter out a stock based on an $8.2 million gap loss, even if it is non-cash, those institutions create what's called a liquidity dry-up. Legitimate long-term buyers just disappear because their own mandates prevent them from participating. This institutional avoidance is the primary structural vacuum that allows these predatory short sellers, who may be using dark pools, to operate with such impunity. The shorts are opportunistic because the big money has already left the building, validating the whole bearish trend.
I understand your argument that the shorts are just being opportunistic, but I'd contend the mechanism itself is structural suppression. You focus on the 80-cent warrant cap as the resistance. I am focusing on the 42% off-exchange shorting as the mechanism of suppression that's keeping the price glued to the 20-cent floor. I mean, why are nearly half the shares sold being routed off-exchange if not specifically to prevent upward price translation? The price action below 60 cents is just dominated by these flows. The warrants set a ceiling, yes, but the dark pools are actively maintaining the seller.
That's a compelling point, but I would ask you to consider the institutional mindset when they see those warrant holders. The warrants represent 10 million shares of guaranteed future supply. So if the price were to reach, let's say, 70 cents, those warrant holders would have a massive incentive to hedge their positions or just exercise and sell, creating a guaranteed supply that dilutes everybody else. The very existence of that overhang fundamentally chills any meaningful sustained momentum that you'd need for the kind of short squeeze you're envisioning. The financing action prevents the positive feedback loop that the high days to cover might otherwise kick off.
But that high short interest ratio of 6.72 days means the shorts are trapped. They need time and supply to cover their positions. So if YYGH announces a significant contract, let's say they demonstrate a successful deployment of their smart cleaning robots in a major corporate facility in the UK, that positive news would force a sudden, panicked demand for shares to cover.
and that demand would just overwhelm the small available supply. The dark pull activity is precisely the tool being used to keep the stock artificially low in the 20-cent zone to prevent that kind of catalyst from sparking a necessary protective covering rally.
I agree that the shorts are vulnerable to a catalyst, but the technical structure of the chart confirms the overwhelming strength of the downtrend. The stock is trading below both the 50-day simple moving average at 24 cents and the 200-day SMA at 27 cents. This confirms a clear death cross configuration, signaling severe institutional weakness. Regardless of any short-term squeeze potential, the company has to address the NASDAQ deficiency. They can't delay it past early 2026. This means a reverse split is coming, and reverse splits, often a big 1-for-20 action, are almost always followed by additional aggressive short attacks that just dismantle any short-lived positive momentum.
I'm not so convinced that historical reverse split behavior dictates the future here, especially when you look at the current technical signals of selling exhaustion. While the long-term trend is clearly bearish, the short-term indicators suggest a potential near-term reversal. You look at the Williams %R, which is a powerful counter-trend oscillator, and it is currently flashing a deep oversold reading below -95. This is the kind of technical signal that tells you sentiment has hit a point of, psychological capitulation. And similarly, the relative strength index, the RSI, is at 33.77, just hovering right near that oversold threshold of 30.
And what does that mean in practical terms beyond just the numbers?
It means that while the fundamental trend is down, the current selling pressure is waning, and rapidly. For a speculative, risk-tolerant investor, the risk-reward asymmetry at this exact 20-cent floor is immense. If the operational growth holds, that 20-cent level is the critical must-hold line. If that floor breaks, yes, price discovery below 19 cents will be brutal, and it will validate all your regulatory fears. But the fact that it is holding against 42% off-exchange selling suggests that latent demand is successfully combating the structural suppression at this precise point.
So, to summarize my position, the extreme price collapse is, I believe, an accurate reflection of this death spiral financing narrative. The $8.2 million gap loss validated the institutional exodus, and the September 2025 dilution, with that 10 million share warrant overhang, created an insurmountable supply wall that acts as a perpetual ceiling. You couple this with the impending 1-for-20 reverse split driven by the NASDAQ compliance vice, and the stock is best understood not as a hidden growth story, but as a volatility instrument that's caught in a fundamental and regulatory squeeze that really self-inflicts its market value.
And my conclusion is that this massive asymmetry exists precisely because the market structure mechanics are actively obscuring a fundamentally growing technology company. The price erosion is a function of the systemic suppression that's inherent in that 42% off-exchange short ratio and the high-volume churn, which prevents the legitimate price discovery that's warranted by the company's performance. YYGH, to me, is a classic fallen angel, where the current 20-cent price is absurdly low when you measure it against its 33.7% revenue growth and that 79.5% gross profit expansion. The potential for a rapid revaluation remains very high if that structural selling pressure is ever relieved.
This company truly represents a complex case study of navigating that gap between business potential and the market reality.
It really does. The crucial variables for anyone listening to focus on are really twofold. First, whether that critical 20-cent support level can continue to hold against this systemic off-exchange selling pressure, and second, precisely how the company chooses to navigate the necessary compliance actions that have to be addressed in early 2026.
Our discussion, I think, confirms that understanding this market complexity requires you to consider three major factors at the same time: strong operational metrics, value-destroying financing risks, and the highly technical mechanics of market structure suppression. There is certainly much more to explore in this material to fully gauge the ultimate outcome.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.